Hey everybody, Marty Mazur here. It's the evening of December 7th, 2023. Wanted to pop in, since I haven't for a few days, and update you on the charts. Got to keep it relatively quick. Blog subscribers, as I promised the other day, I've been a little less active on the daily blog. Posted part 1 of our year-end letter a day ago, and we'll be posting part 2 either tomorrow at the earliest or maybe over the weekend. The latest will be early next week. This is where we dig into the current economic setup with a lot of charts. I'm going to comment on the fact that our recession light has been lit, so to speak, for the past year plus, and explore the dynamics around this economy and what has kept it from going into recession. Actually, the manufacturing sector has been in recession for over a year now. But, we're 2/3 services in the U.S., so the service economy has been very strong, very resilient, and we'll talk about our view as to why that's the case, our go-forward view, and so on. So that's interesting stuff. Going to be relatively lengthy. I may have to break the economy into 2 parts because there's lots that we want to explore. So that's coming in the next few days, and then in parts 3 and 4, we're going to explore what the longer-term outlook is, in our view, for things like the dollar and equities globally, commodities, and so on. So lots of good stuff, I think, over the next 2-3 weeks between now and the end of the year. But again, in the meantime, I do want to pop in when I can and just kind of bring you up to date on the things that we normally talk about. And so the last video I did a week ago or so, we looked at the S&P, the NASDAQ 100, the Russell 2000, Treasury yields, the dollar index, and gold. So I just want to do that again, and I'll talk on each along the way. And we'll just look at the daily charts on the equities, just in the interest of time. And so here's your S&P 500. And the term I've used here of late is that the market is feeling pretty heavy to me. And we have this gap in here, and I could paint that that rising wedge pattern. I guess if I try here, I guess that's legit. Breaking out sideways, if you will. We do have a trend line here. By definition, you've got 1, 2, 3, maybe 4 points here. Clearly, a unsustainable angle of attack there for the market, and it doesn't have to correct down. It can certainly correct sideways. But notice, the look here is not that dissimilar than the look, back here, leading into that top in July, and then we dropped some 12% or so since then, and then we bounced out of it quickly, recapturing all of the loss, at least in the headline index. But here we were, and you can see how we just kind of meandered up here. Somewhat similar pattern, I think you could say. We had a very bearish engulfing candle right here, and an engulfing candle is where the body of one candle captures a day, 2, 3, or more of the previous action. And you can see that was very definite here. So we had this big engulfing candle. Still a couple of up days after that, and then boom, we kind of fell apart after that. Notice here, folks, we have another one. It's not as wide, if you will, or long as that one, but we have an engulfing candle that captured the previous 2 days. And here we go. We have a up day thereafter, but I don't know that it's going to play out. I'm still thinking seasonality may win the day here short term. However, when we look at it technically, I think I said the other day, I would probably be as bearish right now as I was bullish back here if it wasn't for seasonality. We've got quite the lengthy bearish divergences here coming off of overbought, right? Notice back here, overbought, came off of it, overbought, came off of it, rallied into just about overbought territory, and this is what was happening, during that time before finally the market gave up the ghost, right? Here we are. Overbought, came back, overbought, came back, and then boom, here we are, right? Much like we were here. And we have, a pattern that is much like the pattern we had back there. Sell signal happened right here. Sell signal has now happened right here. So we'll see, folks. Again, this was entering in a period that is generally soft, not good seasonally. This is entering into a period or part of a period that is typically really good seasonally. We shall see how that plays out, but the technicals don't allow us to get crazy bullish right here for December, even though it wouldn't surprise me to see the market close higher. As for the NASDAQ 100 or the ETF that tracks it that we look at, very similar pattern, right? Hitting that July peak, closed above it here. We've got this trend line flirting with that 20-day moving average. Very much a bearish divergence. And actually, this is the line here that coincides with this top. So still bearish divergence with the sell signal. Same thing on the RSI. Right, coming off of not quite as overbought as we were here, but right in here coming off of overbought territory. Today was a really good day for the NASDAQ. Today was characterized by really AI once again. Google, or Alphabet, was up like 5+% on the day. They released what they're calling Gemini, which is the largest and, quote, most capable AI model it has ever built. AMD was up a bunch today as well. They have new accelerator chips that will run AI software faster than rival products, according to them. So that was big for the stock and so on. So while the Dow was pretty much flat on the day, S&P, which is also dominated by this Magnificent Seven, a real AI orientation in there, but NASDAQ 100, big time. And it actually came on a day when the jobless claims number actually did a little bit of a number on yields, meaning yields were a little bit higher. I'm going to show you that here in a second. And typically when yields are up, the tech stocks, NASDAQ in particular, has a rough go of it. But not so much today because of the likes of Google and AMD. But we had jobless claims that, I think it was 220,000 initial claims, which was bang on expectations. But continuing claims were down much more than expected. Initially at 5:30 this morning Pacific time in the futures market, that gave a pretty nice boost to the market. Meandered around early during the cash session and then closed higher. It was a very tech-driven rally. Russell 2000 small caps. I was a little more constructive on small caps here of late. I don't know. This is a pretty bearish candle pattern right here that you can see. But we had a good day today. But we'll see. We have a pretty notable gap here and one down here that, I'm still in the camp that thinks the markets have significantly lower to go sometime, into next year if our view of recession odds actually play out. But, it doesn't have to happen right now. It doesn't have to happen initially at the beginning of the year. Yeah, I think you get into the first quarter for very long, and I think that's where things begin to take shape, or our signals begin to tell us a different story about the go forward. Right now, our models, if you will, tell us to remain cautious and to play some defense with our portfolios. In terms of momentum, it's still not bad, barely overbought there. But, there's not bearish divergences here on the momentum. So, you could argue for small caps here, but boy, there's a lot that could bring them down. Tomorrow morning is the jobs number, and that will have an impact on the market, I'm quite certain, one way or the other. And it'll certainly have an impact on bonds as well. And speaking of bonds, this is the yield on the 10-year Treasury bond. This is a bullish pattern that just keeps getting extended here. This is a bullish divergence on the RSI. Can't say that about the MACD just yet. A couple updates here. We would have expected that the higher yields that were probably inspired by the not so bad jobless claims this morning really didn't do much to the stock market. The US dollar, that pattern is playing out exactly like it was supposed to. We got very bullish here. That's bearish for stocks. Remember, we were very bearish here, which was bullish for stocks. Stocks rallied hard during this whole time right here. And they're struggling right now. We did have a big down day, and that was actually today. This little candle here is tonight. This is a live chart. That this was mostly about the yen. Now, the yen accounts for 14% of the counter currencies in DXY, but the yen was up over 2% today. Now, a couple of months ago, I want to say, I spent some time on the dynamics around the Japanese central bank and the Japanese yen, and I said one of the big macro risks out there that not anybody was talking about at the time is when the Bank of Japan abandons, and ultimately I think they have to, what is their yield curve control. So they're keeping their 10-year JGB, Japanese government bonds, within a fixed range. And they're getting that inflation they said they've been wanting for a long time. They hike rates, expand that yield curve control range, or abandon it altogether. We probably are going to see a not small repatriation of capital that has been levered against the Japanese yen because they could do it for virtually nothing, and then invest in other economies where they can actually gain some yield or gain some appreciation. As long as the yen stays weak, that's great for those trades. It begins to rise, and that means it takes more of the foreign currency they converted to pay back that yen debt that they use, called a carry trade, and that's the funding currency. I know I'm in the weeds, and I did this in detail a while back, but long story short, you get panicky repatriation, unwinding of these carry trades, and it just exacerbates that. So the Bank of Japan governor hinted to a rate hike in the not too distant future, and the market just freaked out. So that was a massive move in the yen. And of course, that all by itself, even though the yen is just 14% of the index, that was enough to see some dollar selling for sure. Again, if this uptrend resumes, that's a massive headwind for the stock market, the way things have been trading of late. And then lastly, since I mentioned gold, this pertains to clients specifically as well, because remember, I was painting this really bearish pattern for gold. We're really bullish gold longer term, and I'll give the dynamics around that, I'm sure, in our year-end letter as well. But I said right now, this is a bearish pattern. And right here, literally on this up candle, we bought put options pretty close to the money to protect our gold position. We used GLD, the ETF. Literally, that was Friday. On Monday, it was gold was down over 2%. And clients, you've got some confirmations, because literally the next trading day, we were able to roll that hedge and get all of our money back. So essentially that was a doubling of our options position that we took. And we've done this many times before, and it happens a lot when we're just hedging a position if we happen to get it right. And then it's a beautiful thing, because then we roll down to the price, or a little below the current price. And right now we have free insurance, so we can't get hurt too badly. Gold could drop, double digits in a heartbeat, and that would do something to a position that's not small for us right now. So we're glad we did that. We're glad it's free at this point, and we'll just kind of see how that plays out. So folks, I hope that was somewhat useful. There just isn't any big, strong conviction I can give anybody right now on the short term, other than we know that December tends to be a pretty good month for the market. It generally moves higher, somewhere between low and mid-single digits, which is really good for a one-month period. We've had some ugly Decembers, like 2018. A week or two ago, I showed you charts where I called it past Novembers, but we ended up looking at December as well. And I showed the Novembers over the last number of years where we actually, ended up rolling over into something not so sweet, over the course of the next 6 months to a year. But that was because we had a poor risk-reward backdrop going into those, like we do now. Folks, thank you as always for watching and listening. Talk to you soon. Take care. Bye-bye.